Everybody talks about film tax credits, as you should. If you're an indie filmmaker, film tax credits are super, super important. They could be a huge, huge contribution to your financing, but what really are they? What is a film tax credit? How do you really get it? How much do you actually really get? You need to know the reality of film tax credits. If you want to be a successful indie filmmaker, you need to know a lot about not just the production of movies, but the business. We are going to tell you the truth and reality of what really happens in the indie film business. Okay, so remember I said in the last episode, or actually 2 episodes ago, I said that the most of the money that is going to come from financing your movie is going to come from high net worth individuals, from Uncle Charlie. That's where the money is going to come from. And then last episode, we talked about a pitch deck for Uncle Charlie. So a lot of people say to me, but what about film tax credits? I mean, that could be 25 or even 30% of your budget. I mean, that's a big amount. How come you don't talk about that? Why don't you say that, 25% is going to come from a film tax credit, then the other 75% from Uncle Charlie? And the answer is, it's not going to happen that way. See, it's all about timing. So let's talk about what a film tax credit is and why it doesn't work the way you just think it's going to. A film tax credit is basically an amount of money that you are going to receive back based on how much money you spent on the making of your movie. And you're going to get that money back usually a year or 2 after you make the film. Meaning that you're not going to have that money to use to actually make the film. That's why I don't include tax credits as part of the financing package, because the financing package is the money that you need to make the movie. I talk about tax credits as revenue that is actually going to come back to you afterwards to recoup your investment. So let's just go back and review that for a second. If you need $800,000 to make the movie, $700,000 to make it, and $100,000 to do the marketing. That's the example I used in the last episode. You're going to ask Uncle Charlie for $800,000. Then Uncle Charlie's going to say, well, aren't you getting a tax credit? And you're going to say, yeah, we're hoping to get a tax credit. And just to make the math simple, let's call the tax credit 20%. All right. We're going to go through the details of a tax credit in a minute. But let's say that you expect to get 20% of $700,000, your production budget. You're not going to get it on your marketing, all right? You're only going to get it on your making. So you're going to get $140,000 back. So Uncle Charlie's going to say, well, the government of, let's just call it Oklahoma, the state of Oklahoma, their program is actually 25% and actually 30% if you shoot regionally, all right? But let's say you're going to get 20% back. They're going to give you $140,000. Why do I need you to give you $700,000 to make your movie when you're going to get $140,000 from them? You say, that's correct, Uncle Charlie. We are going to get $140,000 from them, but we're not going to get it for a year after we've actually made the movie. So we need the $140,000 today to make the movie in order to pay the crew, the cast, the locations, the equipment. We have to pay for everything. The $700,000 is what we need to pay today to make the movie in order to qualify to get the $140,000 back in a year from now after they process all of our expenditures. So we're going to have a serious cash flow issue if you only give us, say, $560,000, because we're going to run out of money because the state of Oklahoma is not going to give us the money back for another year. We're going to be short $140,000 to pay our cast and our crew and our equipment. So we're not going to be able to actually finish the movie because we're not going to have the cash. So I got a better idea, Uncle Charlie. Why don't you give us the full $700,000 for the production funds today? And then in a year from now, when the state of Oklahoma gives us back the $140,000, we'll just give it right back to you. So in essence, you've given us really net $560, 700 minus 140. It's a year difference. So Uncle Charlie will say to you, my friend told me that you could take your commitment letter from the state of Oklahoma. And again, I'm just using the state of Oklahoma. I made that up. I could be one of any 28 or 30 states that give tax credits, all right? You could take that to the bank and show them that Oklahoma is committed to giving you $140,000 based on your qualified expenditures, which I'm going to get into in a minute, all right? And they'll lend you the money. Why should I give you the money when you could borrow that money up front against the commitment? And you say, fair enough. While that might be true, let me explain the math on doing that to you. If I go to the bank to borrow $140,000 based on that commitment, then first of all, and this, by the way, is the reality, all right? Everybody's going to tell you, oh, that's the simple math. Go borrow $140,000 from a bank. Yeah, no problem. Have you ever tried to borrow $140,000 from a bank for a tax credit? Let me tell you exactly what's going to happen. Remember, this is called truth and reality. Here's the truth and reality of borrowing $140,000 against a tax credit commitment. The bank is going to say, we will lend you 75% of that. We will only lend you 3/4 of that amount, just in case you misdid your tax credit calculation or you come in at the wrong number. We don't want to take the full risk. We're going to say lend you, just to make the math simple, 100,000 of the 140,000. The cost of making that loan, we're going to charge you 15% interest per year. If you lend for a year, it's going to be $15,000 in interest. And there's going to be $25,000 in setup fees and legal fees to do the loan. And we're going to make you personally guarantee it. So right away, you've got $25,000 in legal and setup fees. You've got $15,000 in interest, and they're only loaning you $100,000. So you're going to get net $60,000 from your $140,000 tax commitment. So now you're going to get $60,000 up front because you have to reserve the other $25,000 for setup fees and $15,000 in interest to pay the bank back. You're still going to be short $90,000 just based on the fees and the interest. You're going to be short that amount of money. So you're still going to run into a cash flow issue, not to mention that you have to personally guarantee the loan anyways. And by the way, the banks aren't being evil. If I was a bank, I would do the same thing. They don't want to take the movie over. This is not a $100 million epic Marvel film. This is a low budget $700,000 indie film. They're worried you're even going to finish it. They might say to you, you need to get a completion bond, meaning like an insurance policy saying that if you don't even complete the movie, that somebody's going to take it over and complete it for you. That's going to cost you another $20,000. All of a sudden, you've eaten up your entire tax credit trying to get a loan on your tax credit. It's not worth it, folks. The math does not make sense on borrowing money against a low-budget indie film tax credit. The numbers don't work out. Just the cost of setting up the loan, say $25,000. Again, I'm making that number up. It could be high, it could be low. It's in the ballpark. Against a $140,000 loan, which is only going to be a $100,000 loan. When you're talking about a $5 million or $10 million loan, and you're spending $25,000 to $50,000 on legal fees, that's not a big deal. But when you're talking about a $100,000 loan, that's a huge amount of the loan amount. The math doesn't make sense to do that. All right. So do not think that you're going to finance your tax credit. Even if you could get a bank to loan you, it's not worth it to you. It's going to eat up most of the credit. So don't consider a tax credit as financing for your movie. Consider it as revenue afterwards, that you're going to recoup your investment from. That's part of the revenue stream, because that is realistically how it's going to work. If you're lucky, you'll get the money in a year. Some jurisdictions take 2 years, some even take longer. And that's assuming you're super organized, you get everything in on time, you get your audit done, you get everything done properly. So that's the reality. So what I'm saying is get the entire amount from Uncle Charlie. Get the $700,000 of production funding from Uncle Charlie up front, because you're going to need it to cash flow your movie, and consider your tax credit as revenue and give it back to Uncle Charlie afterwards when you get it. Don't put it into your financing plan and think that you're going to get it from a bank, because you won't. All right, now let's look at what tax credits actually are. So people use the words tax credit very loosely. There are about 30 states right now in the United States that give what we call financial incentives. Some of them are tax credits, but some of them actually aren't tax credits. Some of them are just basically grants or rebates. They're giving you the money, and it's not necessarily about anything to do with tax. So I'm going to sort of debunk the myths of what all these things are. It's a little complicated, and I'm not going to go into a ton of detail. So viewers who have questions, if you want to write in, we can get into more detail. But if you really, really want to know about this stuff, go either read about it more online or go see your accountant and get the reality of it, all right? There's kind of 3 levels or 3 styles. The first style, there's these states, say 30 states right now in the United States, that say to filmmakers, we want you to bring your film to our state. Why? They want you to spend the money that you're going to use to make the film, that's $700,000 that we keep talking about. They want you to spend it in their local economy. 60% of that money is going to be spent on labor, approximately. Okay, that's more or less, when you look at a film budget, 60% is about labor on a low budget indie film. So you're going to spend $420,000, 60% of $700,000, employing people in their jurisdiction. That's good job creation. They want job creation. The other amount you're going to spend, the other $300,000 or $280,000, you're going to be spending it on goods and services. So that's going to stimulate their economy. You're going to be using their hotel rooms, their equipment suppliers, their Ubers, their food suppliers, all their services. You're going to be spending money in their state as opposed to another state. One $700,000 film is not going to change the needle. But once you start looking at hundreds of films or hundreds of bigger films, like in the state of, say, Georgia, where they're doing billions of dollars worth of production, that creates a lot of economic stimulation in that economy. Hence the reason that states like to attract that business. Now, states don't just give tax credits and financial incentives to films. They give it to lots of other industries as well. Research and development, biotech, mining, all kinds of industries get these credits because states want the labor and the economic activity to come to their state. All right, so films is just one of those categories. And it has been a very lucrative category for lots of states. I mean, today, the biggest state is Georgia, is doing the most. California, where I live, is trying to catch up, but we have a limited amount. Georgia's got an unlimited amount of tax credits, so they do billions. We do here in California $330 million. The governor's trying to increase that, double it, and we'll see what happens. Louisiana used to do big numbers. New Mexico, New York's doing huge numbers now. They're using these financial incentives to attract the business to come to their economies so that people will spend the money in their economies and create jobs and other economic activity. That's the reason it's done. Now, there's lots of arguments, by the way, from a lot of legislatures saying it's not worth it. We're spending more than the benefit that we're getting. So I love reading about this stuff. I find it fascinating. I know you probably find it super boring reading tax analysis and all this kind of stuff, but like, is a tax credit actually good for the local economy or bad? So I love that. That's another lecture for another time in another webcast, because I'm not going into that, but I do enjoy trying to understand that. So let's look at what these financial incentives are. All right, so the first type of financial incentive is called a rebate. So a rebate is basically giving money back to a filmmaker based on the amount of money that they spend in the local economy based on expenditures that the government there wants them to spend on. Call it the Film Commission of the state will have a list in their financial incentive program and say, here's what you need to spend on, and these are what we call qualified expenditures. All right, these are expenditures that qualify for an incentive. So say the state of Oklahoma says to you, if you spend money on our local labor, on our trucks, on our equipment, on our locations, our hotels, and they list it. And the lists are very long, like hundreds and hundreds of items of things that are qualified expenditures, then we will give you back 30 cents for every dollar you spend, 30%. I'm just using that as a number. Sometimes it's 35, sometimes it's 25, it's 20, depending. So basically, after you're finished shooting, you keep your receipts, you keep everything in order, because you need to prove to us that you actually made those expenses. And to prove it to us, you're going to submit your reports, but you're also going to have an audit done. So you're going to hire a CPA firm, registered CPA firm. They're going to do an audit on your expenses, and they're going to verify that you actually spent the money that you did. And once we verify that, we're going to give you back 30% of that as a reward for spending your money in our state, on our people, and our qualified expenditures. That's fantastic, and it works. And if you keep your expenses proper and you get the audit done and everything like that, you're going to get your money. It's going to take about a year from the end of the time you finish shooting, and then you got to post and do all this kind of stuff. And depending on where you spend your money, it's about a year to get that money. And sometimes it's longer depending on the jurisdiction because they're backed up a little bit more. So say a year to 2 years. All right, sometimes you get it quicker. Certain jurisdictions are very quick, but you're going to get that money. It's fantastic. Now, a 30% rebate means they're just going to send you a check for 30% of your qualified expenditures. You're not going to have to file taxes. You're not going to have to go through the tax department. It means you spent the money here. We are going to reward you. We're sending you back a check against that money. So people still call that a tax credit, but it's actually not a tax credit. It's a rebate. It's a gift back to you, rewarding you for spending your money. That's level 1. Level 2 is what we call a tax credit. So now they're going to say to you, same type of thing, spend your money on these qualified expenditures. We'll give you 30% of it. So let's say that you have a tax credit of, I'm just going to again make up a number, of $200,000. We're going to send you a check for $200,000, all right? So then they say to you, okay, but we're not sending you a check in the case of a tax credit. What we're going to do is, if you have taxes owing in our state, so you have a company here and you've generated a certain amount of profit and you have taxes owing against that profit, you can offset those taxes owing with the amount of tax credit we gave you. So if you have $200,000 of taxes owing to the government based on your profitability as in your company, then we will allow you to take that tax credit you earned and reduce your $200,000 by $200,000 and pay us zero. You don't owe us any taxes because you got a tax credit of $200,000. So that's an offsetting, and that's actually a real tax credit where you're getting the credit to offset the amount of taxes that you have to pay. That's a true tax credit. Now, what happens if you don't have any business in that state? Like, for instance, I live in California and I go shoot my movie in Oklahoma, which, by the way, I did. I shot a movie there, okay? But I don't have a business there. I don't have any revenue. I don't have any taxes owing. Well, that's a rebate program, but let's say it was a tax credit, right? Then they say to me, we're going to give you a tax credit. And I say, well, that's wonderful, but I don't owe any taxes. What am I going to do with a $200,000 tax credit if I don't have to pay tax because I didn't earn any revenue here? So some states say, too bad. And if they're going to say too bad, that's not good for you because you're going to basically walk away from that whole program. You just spent all your money there for the reason of getting the tax credit. So they say what will allow you to do is you can sell your tax credit to a local company that actually does have taxes owing. So there's a lot of big companies that have a lot of taxes owing, and they'd be willing to buy your tax credit from you. Why would they want to buy your tax credit? Because you're going to have to sell it at a little bit of a discount. So if you have a $200,000 tax credit, they might say to you, we'll give you $185,000 for your tax credit. So you'll get that. We'll write you a check for that. And then we'll take that tax credit and offset $200,000 worth of taxes. So they're getting a $15,000 benefit from buying your tax credit from you. And that is what we call a transferable tax credit. So you're transferring your tax credit because you can't use it to a company that can at a discount. Now, you're also probably going to need a broker to do that because somebody's going to have to figure out who's buying credits and who's selling them. So there's a broker involved, just like there are in real estate deals or any deal, and they'll take a little bit of a commission, 2 or 3 or maybe 5% or something on that sale. So maybe you've discounted it by 15% and then you have to pay a brokerage fee of, say, $5,000. So you're going to get $180,000 on your $200,000 tax credit just because you had to sell it because you're not eligible. You don't have taxes owing, so you can't use it for anything. That's called transferable. Now, the only other sort of level is sort of a combination of rebatable and transferable. So let's say that you have $200,000 tax credit, right? And you have $100,000 of taxes owing. So you can't use your whole tax credit. But you actually have business and you have $100,000 of tax credit, but you have a $200,000 tax credit. So what you can do in certain states is you can take the $200,000, use $100,000 of it to offset the $100,000 in tax credit owing. So now you've got an extra $100,000 that you didn't do. Then the state will refund it to you. They'll actually send you a check for the difference. That's called a refund, and that's called a refundable tax credit. Meaning the difference between what you offset your taxes and what the tax credit is, that's the amount of refund you're going to get. Now, all of this sounds like a lot of gobbledygook, I'm sure, to a lot of you. Why? Because you're filmmakers who make films, you're artists. And this is all accounting tax talk. I mean, when I teach my students this, their eyes roll to the back of their head and their head spins around. Literally, this makes everybody's head spin, what I just talked about. So here's the thing. You do not have to know how to do this stuff. You just have to know that it exists. All right? As a artistic filmmaker, I don't expect you to understand tax credits. I mean, I understand it because I teach it and I do it and I like it and I have a finance background. All right? So that's why I understand it. But you don't need to know the details that I just explained. You just have to understand that this stuff exists, and you have to know that it's accessible and that you should be looking into it and accessing it for your project because it helps. It's revenue afterwards that is going to help recoup your investment. So don't leave it on the table, and just understand the narrative that people who are going to process it for you are talking about. So hire a lawyer, hire an accountant, hire a producer or somebody who understands how to do this stuff, and let them do it for you. Let them assess it, figure it out, manage it for you. You'll obviously pay them a fee, but it's worth it because there's a lot of money involved here. And if it's going to make your head spin, no problem. Just understand that it needs to get done. It's another one of these things that's not your skill set, but it's somebody else's. So bring them in to let them help you manage that. All right, I just explained on a very sort of cursory level how it all works. But if you don't want to go down that road, don't worry. Just understand that you should be accessing these incentives because they're important and they matter. I don't want to complicate it a little bit more, but I do have to explain this one component because this is super important. So a lot of people get this wrong. They just assume that the amount of the tax credit program is the amount that they're going to get in a tax credit or in a financial incentive. And that is usually never the case. It's very rare. So if a program says, let's say a 25% tax credit program, and let's make the math simple, okay? You're spending $1 million in a state, and they say you're getting 25% tax credit. Well, first of all, you're only getting 25% on the eligible expenditures. Remember, it's only the things that they say you have to spend your money on. Now, I am telling you from experience that even if you use all the resources, even if you spend everything in that state, there's some things that you're going to have to spend on that are not going to be eligible expenditures. So on average, only 90% of your expenditures are going to be eligible or qualified expenditures. Qualified was the word I used, right? The other 10%, even though you're spending the money there, they're just not on the list of qualified expenditures. So right away, you're only going to get 25% of 900,000, not $1 million. So that's going to take the amount down. So now, instead of getting 250,000, maybe you're getting 10%, 240,000. So right away, you're not getting 25%. Then if you have to sell your credit, then you're going to have to discount it. You might have to discount it by 10 to 15%. You might have to pay a broker another 5%. So right away, that's going to reduce the credit by another, say, 15 to 20%. So now all of a sudden, your $240,000 tax credit might be worth $200,000. And again, I'm not doing the math properly here, okay? I could do it on a computer for you, but I'm just trying to simplify it. So now all of a sudden you have a $200,000 tax credit on a program that was 25%, and you factored in that you're getting 25% of $1 million. You factored in 250,000. But in essence, you're only getting 200,000. And by the way, it's going to take you 2 years to get it. So if you borrowed money against it, it might be another $50,000 in interest and borrowing fees, which means you're only going to get 150. But let's not factor that in, okay? So your 25% tax credit, in essence, is actually only worth 20%. That's the reality. So when you're doing your planning, this is money you're getting back after the fact. So this is revenue coming in. So when you factored into that, what it's really going to be, 200,000, 20%, not 25%, even though the program states 25%. But I'm telling you from experience, a lot of these expenditures won't qualify, and then there's going to be fees and other costs and everything to actually process it and put it through. Not to mention the cost of doing the audit, the cost of applying for the tax credit. There's other administrative costs that I didn't even factor in that are going to reduce the effective net amount of the tax credit. In essence, I am telling you from experience that most financial incentives, i.e. tax credit amounts, come in at about 75 to 80% of what the program actually is. So if it says it's a 35 or 30% tax credit, you're probably going to get 21% or 22% or something like that. All right. You're not going to get 30% because I'm talking after all of the costs, all of the elements are factored in. So many filmmakers make the mistake of saying when they're doing their plans, oh, got $1 million film, 30% tax credit, $300,000, that's my revenue. No, it's going to be $220,000 if you actually know what you're doing and you know how this whole system works. So just be real, be practical so that you don't have to be disappointed, because in this case that I just gave you, you're going to be $80,000 to $78,000 out of pocket that you planned for from a tax credit that you never got. And that's not going to look good on you. It's going to be disaster because the money all of a sudden disappeared because you didn't know how to factor it in. And again, this all comes with experience. So that's why I say if you don't know what you're doing, deal with somebody who does and who tells you the truth and is honest and works out the net amounts exactly right. But in the end, these are great incentive programs. So tap into them as much as you can. All right. They're all over the place. Check them out, read about them, and get somebody to hold your hand who knows them better than you do. And then you will get the benefit of them. So good luck. I encourage all of my listeners to send me questions if they're curious about certain topics or they want more information on things that I've spoken about. So my email address is jdeverett@deverettmedia.com. It will be in the show notes, and feel free to send in your questions and we will hopefully be able to get to them and expand and give you the answers.